Alrighty, good morning everyone. Thank you for attending our webinar. My name is Tim Hard. I'm a Director of Private Mortgages Australia. And I really want to talk about this morning is a little bit more about private lending, and especially at the moment where we've got a very, very restricted lending environment. The Royal Commission and the banks really tightening up. So I want to talk about where private lending fits in that. It's definitely becoming a lot more popular as the banks sort of pull out. And then what I'm going to do is tell you a little bit more about development finance in particular, because we're sort of noticing that's a big growth area at the moment as the banks are becoming increasingly difficult to deal with when it comes to anything to do with development. So I just really want to walk you through how we work with a lot of our referrers. And how you might be able to look at private lending if as another solution for your client, if the banks either say no or the banks can't lend you the funds within a certain time period. Typically, private lending, it's as you'll see, it is more expensive than a bank loan, but there's a lot more flexibility and a lot more speed that comes with that as well. We recently just settled a deal last week. We got the application on Thursday, and we were ready to settle by the Monday. The other side actually wasn't ready to settle. It got postponed to the Tuesday. So really, really fast turnaround sort of stuff where people want to settle within a couple of weeks. They can't afford to wait the 6 to 8 weeks that a bank typically takes. But let's jump into it. If you do have any questions, you can. There's a little questions box. But otherwise, we will be recording it, and I'll put it on our website as well, so that if you couldn't quite make it or you had any other questions, you can always ask us afterwards. Let's just have a quick look at what sort of private lending products there are out there, and this is the product suite that Private Mortgages Australia has. So we do first mortgage lending, like most banks in Australia do. We have interest rates that start from 1% per calendar month, so sort of a 12% per annum, and that's due to the short-term nature of our loans. So typically our loans, shortest loan is sort of 2 months, and we'll do anything up to 36 months. But our average loan is probably around about that 6 to 12 months kind of mark, so really short-term funding. And at the moment, we'll do loans anything up to $2 million. That is going to be increasing to 5 and probably 10 by the end of the year, so just do stay tuned for that. The other area that we do, and a lot of private lenders will do, is also second mortgages or caveat second mortgages. So something that no bank would do is sort of sitting second place to someone else. As you can imagine, there's a lot more risk involved with second mortgages, so the interest rates are slightly higher. So you're starting to look at second mortgages from 1.5%, anything up to 3.5%, depending on the risk of the transaction, and anything up to $1 million. And the last one, a caveat loan. This is where we can settle on a property where we literally don't have time to register our mortgage, that we can settle on just a caveat. So those are the ones that really need to settle quite urgently, and usually they're for a very, very short period of time, where we'll do anything from 2 to 6 months. You can see the interest rates are quite a lot more for that as well. So you're looking at a minimum of 3% a month. So it's only sort of certain circumstances that those make sense for clients, but there's obviously a lot of risk from us, and a lot of speed that comes with that as well. So let's look into the loan to value ratio. So what we've got here, we've broken the postcodes of Australia into 4 postcode categories. So this is based off the Genworth Financial postcodes. So category 1, that's most major metropolitan areas. So your Melbourne, Sydney, Brisbane, anything probably within 50 k's of that is all considered category 1. Category 2 is usually your major regional towns that perhaps don't quite hit the population required to be category 1. Category 3 is usually your smaller, more rural towns, and category 4 is affectionately known in the office as whoop whoop. So it probably is literally in the middle of nowhere, and you'll find that most banks won't lend in category 3 and 4, and even a lot of private lenders don't do category 3 and 4, and a lot only focus on category 1. So as you can see, rather than sort of saying no to different categories, we just obviously have slightly lower LVRs that we'll do. The other really interesting thing about this is you'll notice there's a maximum column. So as much as we have in our policy that category 1 residential security will go up to 75% LVR, we actually have discretion to go up to 80%. Okay, now for us to do that, it's looking at different factors. You know, how strong is the sponsor, but we also have a special analytics firm that can look at where the suburb is headed, and if we can see that it's a suburb that's headed in a good direction, we look like there's some good supply and demand characteristics for it, and it's going to go up, then that allows us to lend to those higher levels. So the other one you'll just notice here as well is development. As I said, we've got most of the time it's around about 65%. We do have discretion to go up to 70%, and that's quite a big thing we're seeing in the marketplace at the moment. A lot of the banks are saying no outright, but they're also coming in and reducing LVRs significantly, where they might approve a 60%. Next thing you know, we had one the other day, 1 week before settlement. Oh, sorry, actually, we're only going to do 50% LVR. Can you chip in another $1 million kind of thing, which obviously the client didn't have. So let's explore the development side of things a little bit further, just because it is such a hot topic at the moment in this current environment. So there's 3 different types of development finance products that we offer. The first one most people are familiar with is a senior finance facility where we've got a first mortgage. And it might be something like a 12 to 24 month term, and we'll do up to 70% of the GRV, or the gross realization value of the project. Another one we do is mezzanine funding, where we'll sit second place to the bank if the person needs a little bit more of a top up. So if the bank might do a 60% LVR, we might be able to top them up to 70, give them that extra little 10% that they need for the project. And the last one is pretty specialized, actually. Not a lot of lenders like this type of finance, is completion finance, where you get a client who gets halfway through a project and they run out of money. Something happens, they've run out of contingency, they hit rock, or something's gone wrong where they can't get any more money from the bank. So banks hate lending on incomplete security because it's just such an unknown. And so we've come in a lot of time where we'll come in and actually just give them the funds that they need to be able to then complete the project. It's usually very, very short term in nature. They've got the pre-sales there. They just need a couple of $100,000 to finish off the build, and then it's all going to settle out. So they're the sort of the 3 key products that we look at. I'm just going to go through an example of each one quickly so you can get a bit more of a flavor of not only what we do, but also the rates that we charge for that as well. So this little timeline I've put together here is just more of a visual thing for those people out there that are visual like myself. Mezzanine and senior typically done all at the start of the development before anything starts happening, whereas completion comes in right towards the end of the project. Okay, so let's have a look at a case study here for senior finance. Is a development site in Willowvale in Queensland. It was a gentleman who lived on the property, and he was subdividing it into 5 lots, and he wanted to remain keep his own home on one of the titles, and had sold the other 4 lots off. So a great deal, but the bank would not service him due to lack of serviceability. Whereas with private lending, we're more focused on the asset and particularly the development, the project itself. We're not relying on the sponsor to service it. Okay, so that can be a really big advantage for someone to go and get a private loan where serviceability is not an issue compared to a traditional bank. So the valuation on this property came in as if complete. So the gross realization value was 2.125. We did a first mortgage with drawdowns for him of 1.475, which was a 70% LVR. The interest rate was 1.5%, but as I said, that was only done as he drew down the loan, and the term was for 5 months. So that one, funnily enough, is just due to be repaid in the next couple of weeks, and is all gone really well. So the other one we have here is a development site in Glen Waverley in Victoria. Now we do lending Australia-wide, just both. So you can see that's why mainly eastern seaboard, but you'll see that's where quite a few of the examples are from. It was a 3 townhouse development. The borrower wanted to develop to keep, so they had no pre-sales. And bank finance was not available due to the lack of pre-sales. So pretty common scenario we're seeing. Banks usually wanting it, most of them wanting 100% debt coverage with their pre-sales. So to be able to get no pre-sales is pretty special, which is why they sort of came to us. The valuation came in at just over $4.5 million. They already had a first mortgage with HSBC for $1.6 million, so we came in with a second mortgage facility for $1.358 million, which is a total LVR of 64%. Interest rate on the second mortgage there was 1.95%, so slightly above sort of our minimum because it had a bit of that development risk in there, and the term was for 12 months. Once again, this is done on a drawdown basis for the client. The last one is a development site in Altona North. It was a 3 townhouse development as well. They already had 2 of them pre-sold, but they basically ran out of money. So they were trying to sort of cash flow the development themselves, and they got within a couple of months, and they owed the builder a lot of money. They owed the builder about $330,000, and he wasn't prepared to wait a couple of months to settlement to get paid. So so they ran out of money. Their bank finance was unavailable because this was their first development project, so they didn't have any any experience. The security property was halfway through being built, and they lacked serviceability because they were self-employed. So myriad of reasons why they couldn't get the bank funding on this one. We got a valuation done that came in at 1.95. They had a first mortgage with Latrobe for $520, and we gave them a second for $435. So 49% LVR for that one, interest rate 1.9% per month. The reason that one's probably a little bit higher is because it's only for 2 months. So typically the shorter the term, the higher the interest rate, whereas a client that wants, we're going to get interest for say 12 months, that'll help bring the interest rate down as well. So let's look at because it's not all just about interest rate. And so we just want to have a look at what are the other fees and charges that are associated with a private loan. And one of the big things that we really push with our referrers is to not look at the interest rate. Like the interest rate of a loan is almost irrelevant compared to the total cost of a loan. Now the example we had it was probably about 6 months ago now. We had a loan where they had sourced an offer from another provider, and their interest rate was 9%, and our interest rate was 18%. So we literally double their interest rate. However, once you took into consideration their line fee, that brought their interest rate up to 13%, and all their fees and charges and costs, they actually were $100,000 more expensive than us because of all the other fees and charges. So even though our interest rate was more than theirs, it's all about the total cost, and it just makes it a nice, easy decision for the client to look at a transaction, and especially a developer. Okay, for me to get this funding, it's going to cost me this much in interest, this much in setup. It's going to cost me maybe, I don't know, let's say $70,000. Does it make sense to spend $70,000 to do this project? Okay, so if you're going to spend $70,000 and the project's going to make $1 million, then it's a bit of a no-brainer. Whereas the project's only going to make 50 grand, you're probably not going to proceed with a loan. So that just makes it a nice, easy decision and allows them to sort of compare apples with apples as well. So in terms of referral fees and sort of the upfront fees that we charge, so we have an approval fee. So it varies on the loan amount. So it starts at sort of 3.5% and then drops down to 2.75%. Now, built into that approval fee is our referral fee. So let's say we did a $300,000 loan. The approval fee would be 3.5%, and included in that is 1% that gets paid to our referrer. Now, the reason we do this and we include it is that we needed to become channel agnostic, which basically means it doesn't matter if your client comes to us directly or they go through you as a referrer, they're still going to be paid the same amount. So they're going to be charged the same amount. Okay, so there's no incentive for them to come to us directly. So that was just some feedback we got from some of our referrers that they wanted to see that in there, which is why we've made that change. So that's if once the loan proceeds at settlement, we'll draw that approval fee. Prior to that, the only cost that the client would pay is we charge a one-off assessment fee, which is between $550 to $770 based on the complexity of the transaction, to really just cover our cost of doing the due diligence, doing the title searches, the bankruptcy checks, and looking at the file. Any legal fees that are incurred when the loan proceeds is all done at cost. There's no margin there, and same with valuations. So they're always done at cost. We don't always require a valuation. We do have a pretty flexible valuation policy that we can use third-party valuations that were done within the last sort of 6 months. And it allows us that we just pass that cost on to the client. The other way that we work with referrers is we allow our referrers to put into the offer a service fee. So you might say, look, I'm going to get my 1% of your approval fee, but hey, this is a development transaction. I've got a lot of work I need to do, so I'm going to add in another $1,000 or $2,000 as a service fee that we put into the offer for you. Or alternatively, you can also mandate your client directly. So if you want to have a separate mandate, you might have a mandate for $2,000, but you'll also still get your share of the approval fee. So it just allows you to sort of dictate how much you make per transaction. Ultimately the client has to be comfortable with it, but that we make that your call. Now, the next thing we do that I don't know of any other lender in Australia that does this is that we pay subsequent referral fees even if the client comes direct. So if you recommend and you refer John Smith to us, and he borrows some money, he pays it back, he then comes back again, and he comes to us directly, we will still pay you your share of the approval fee. Which is pretty cool for us. It's a really cool thing to do, to be able to call up one of our referrers and say, hey, John came back, we've looked after him, can you send me an invoice for $4,000 or whatever the case may be. So it's just us sort of acknowledging and thanking you that they are your client, whether or not they go through you or they come direct. Now, the only time we wouldn't pay a subsequent referral fee is if John Smith went and got a different referrer, like a different broker, who then referred the transaction to us. Obviously, we're only going to pay one referral fee, but that's the only circumstance where we wouldn't. The last one we have is our referrer rewards program. Now, this is just as an extra bonus, I guess we have, and it's more designed to be around volume. So those that are sending a lot of transactions to us. So the first milestone is only $500,000. So a $500,000 loan, you're then eligible for a $250 gift card of your choice. So it could be Dan Murphy's, could be Flight Centre, could be Coles Myer, whatever you want, and then it goes up from there. Now, it's worth noting as well that they are cumulative. So if the first loan that you settle with Private Mortgages Australia is a $2 million loan, then you would get the $1,000 gift card plus the $500 plus the $250. Okay, so you get all the previous gift cards as well. As soon as you hit $3 million, you then enter what we call the PMA's Platinum Playground, whereas provided you set at least $500,000 a year, you'll also get a bonus $500 gift card each financial year that you maintain that. Okay, so that's majority of how we get our business. Probably 95% of our business comes from referrers. So that's why we're very big on looking after our referrers and making sure that when it comes to a private loan, they've only got one place that they know to send it, that we're going to be looking after their client for them. So let's just go through to I suppose our process. And with private lending, it is all about speed, and so it's trying to make this as streamlined as possible. So our process is we'll get either an application form filled in, or we've also got a quick app. And our quick app is literally a 2-page document that you fill in. It's just the real high-level detail of the transaction. We can take that information, we do our initial assessment, and what we come back to is our indicative letter of offer. So that your client's going to know, hey, here's what the interest rate is, here's all the fees, costs and charges, and here's what the settlement sheet's going to look like for you. At that stage, there's nothing for the client to pay. It's only once they accept the indicative letter of offer and they pay the assessment fee, that's when we then complete our due diligence. We then issue the formal letter of offer. Once the formal letter of offer has been executed, the documents are usually done within 24 to 48 hours, and then settlement is shortly after that. So it's all designed to be very, very quick, streamlined process and make it nice and easy for someone to be able to put up an application and get a bit of an idea of what the cost might be and some of the timeframes. What I want to go through just now before we finish up is actually qualifying a deal. So this is what we call our first filter. So when any loan comes in, this is the first things that we check to make sure it's actually going to proceed. Now, the very, very first one is the loan non-coded? So is the purpose of the loan for business purposes. So, so I'll just go back there. So what we want to see there is if it's a company that is borrowing the funds, the loan is automatically deemed to be a non-coded loan, not governed by the National Consumer Protection Act, and there's no Australian credit license needed for it. So that's why it has to be for business purpose, and at least 50% of the funds used for that. So if someone's looking to buy their own home in their own personal name, or they're looking to, I don't know, go on a holiday or buy a car, we can't help them. It's not what we do. So that does knock out a few deals, but it's nice and easy if it's a company that's borrowing it. It makes it nice and easy. The other one is if it is a commercial property as the security property, same again, that's automatically deemed to be a non-coded loan. Now, although we do commercial finance, I just want to make the point that we can take residential property as security. It's more about the purpose of the loan has to be business, not so much the security. The next check that we do is 1% per month. Okay, so the cheapest loan that we'll ever do is 1% per month. So we need to understand that the client knows that they're accepting to pay at least those sort of rates, that they're not expecting it to come back and be like a bank rate at 5 or 6% per annum. It's just not what we're in there for. So we just want to make sure that the expectations are being set, that the clients be able to pay those sort of rates. The next one is the postcode and LVR, or the loan to value ratios. So based on that table I showed you at the start of the presentation, is the client willing to accept reasonable loan to value ratios? They're not trying to get a 95% LVR, and they're not trying to get an 80% LVR on a property that's in the middle of nowhere. Okay, so just as long as it fits within those guidelines that we set. The next thing we want to know from our referrers is what if there is any referrer service fee or mandate. Now, we like to know that up front before we put the offer out. Okay, what we don't like is to put the offer out, everything gets accepted, and then a mandate comes in at the last minute. Okay, we really want to make sure it's all fully disclosed to the client exactly what the fees and charges are right from the get-go. So we just need to know that up front. The next one, probably one of the most important ones, is the exit strategy. Where we're doing a short-term loan, and all of our loans come with a prepaid loan term. So it might be a 6-month loan, and we prepay the payments for the 6 months. Okay, so there's no serviceability required because there's no payments for the loan. It's a prepaid loan. But what we are very, very strict on is what is the exit strategy. Okay, we want to make sure we're setting the client up for success, and we want to make sure that they've got a really good exit strategy. So it might be, hey, I'm going to sell this property. That's how I'm going to get the money back. If it's development, might be some pre-sales. They might be getting some cash in from wherever it might be, or it might be just a refinance to a more traditional lender when they've got a bit more time. So we just want to know what that strategy is, so we can sort of plan the loan to make sure it's going to get paid out at the end. Second last thing is, why can't the client get bank finance? Okay, something we want to know right up front. What's the issue with this loan? Because look, we're going to find out anyway. And if the answer is that the client can get bank finance, don't use us. We're never going to be as cheap as a bank. Always go to the bank first and see if you can get the funding. It's only if they can't that you would send them through to a private lender. Okay, we're just not in the market to compete on price with a bank. It's more about that flexibility and speed that we really compete on. And the last one is, when does the client need to settle? With private lending, it is sometimes we do have to come in, sort of some quite urgent applications. So rather than like a bank who just sort of puts it in the big sausage machine and comes out whenever it's kind of ready, we really want to know, when does the client need to settle? So that way we can all work together to make sure that actually happens. Because there's nothing worse than getting all this work done and then we miss the settlement date and the loan doesn't proceed and it's all been for nothing, sort of thing. So we just really want to make sure we're working with the client to get it settled when they need it settled. Cool. The last thing I want to cover here is this is a couple of the other things that we do. So we really specialize in urgent funding. So where the client can't wait the 4 to 6 to 8 weeks that a bank takes, that needs something a lot sooner. Development funding, which we've gone through. Asset lending, where the client can't show serviceability. We're very comfortable with ATO debts, so happy to pay out an OTO debt. because a lot of the time most banks won't lend unless a client has a clear ATO portal. Another thing we've done is refinancing existing caveat loans. So where a client has gone and taken out, perhaps a very, very expensive caveat loan, it's maybe expired and it's now in default. We saw one the other day where the default interest rate on this caveat loan was 15% per month. We'll be able to come in there and refinance it down to just 1.9% per month for them. So just some things there we can sort of help clients get out of those really expensive loans. Another big one we do is valuation not contract. So we've had a couple of situations where we've actually lent, one we did 112% LVR on contract price, but that's because it was only 70% of valuation. Okay, so it was a long settlement. They had I think it was a 3-year settlement. But where we live in the real world, we understand that the value of the property can be more than what someone bought it for, and what's on a contract. So we're happy to look at the true value of a property. And other ones we've got paying out business partners or someone that's got an urgent business opportunity. And the last one is credit impaired. Okay, so because we're more in that asset lenders sort of pool, we're not so much interested in the person's credit. Okay, whereas the only time we would be concerned about someone who has impaired credit is if their exit strategy is to refinance. Okay, we want to make sure that that they're going to be able to get that finance at the end of the term. So that's the only time that sometimes credit does come into play. So just to finish off here, just to recap on sort of the PMA way, and our big slogan is all cleaner loans, better results. Okay, so it's all about full disclosure and letting people know exactly what happens in the process, so that we have better results for all our clients. So the way we do that is we have low upfront assessment fees. Okay, we don't charge big upfront fees before anything's actually happened. Literally it's $550 to $770. We have no charging clauses and no cancellation fees in our indicative letter of offer. So if they sign the letter of offer and they pull out or it doesn't proceed, there's nothing else that they need to pay. Any valuation is done at cost. We also do it for a reasonable value. Okay, some other lenders will get a valuation and you'll see the purpose of the valuation is a forced sale, which is basically telling the valuer, put a really, really low figure on this valuation. So they might be lending 70% LVR, but because they've put in such a low valuation, it's probably more like a 50% LVR. So just something to look out for, that not every lender does. Legal fees are all done at cost. We also have capped interest rate ranges. So our first mortgages, they're going to come in between 1% to 2.5% per month. And it's not suddenly going to come back at 5% per month or anything like that. The range it's going to come in. We also rebate unused interest on extension payments. So all of our loans have a prepaid loan term. So let's say the prepaid loan term might be, say, 6 months. What we'll normally do is also give that client, say, 3 months worth of extensions, where they can make a 1 month's payment of interest, and we'll extend the facility for them for 1 month. Now, if the client extends for 1 month and then, 2 weeks into that month, they repay the loan in full, they just had a slight delay on settlement, we'll rebate the interest that they've already paid for. So the extra couple of weeks interest of the month that they paid for, we rebate that from them, so they're not paying any extra interest. The other one we have is custom-built software for faster deal processing time. So we've spent, well into the 6 figures now on software, and it's sort of custom-built so that we can process a loan extremely quickly from start to finish, because ultimately that's really what the marketplace is demanding from us. And I suppose it's we're putting the resources in to make sure that we can give that really quick experience to our customers, because all I suppose the focus for us is to have a very high level of repeat customers, and we do. A lot of other private lenders out there probably see a client once and then that client never wants to deal with that lender ever again, whereas we have clients, and it's all about that win-win approach to lending, is that they have a good experience and they want to come back again and again. We'd prefer to deal with a few clients many times rather than a new client every single time we're doing a loan. So that's why PMA is very, very different in that space, in that private lending space. So guys, look, if you do have any questions, or in particular, if you've got some scenarios that you want to run past us, maybe you've got a client that's got a situation that might need some private funding, please contact our senior relationship manager, Shanta. There's her direct number and email there, and happy to run past that, and she'll look after you. The other thing that's worth mentioning is our website, privatemortgagesaustralia.com.au. There's a great little resources tab there. Now this video and previous videos we've done will be logged up there, so you can watch this again. But there's also a lot of training stuff and a little bit more information on private lending. So please, yeah, go check that out and see what you think. But anyway, guys, thank you for joining me this morning. We'll keep it there. We'll keep it to the half an hour, and we look forward to doing some deals with you soon. Thanks.